Hey traders, Gavin McMaster here from Options Trading IQ, and today we're talking about iron condors and specifically how to delta hedge them. As you know, iron condor is a neutral trade, but they don't usually stay neutral for long. As the stock or the index moves up and down, they start to pick up either positive or negative delta. So today we're going to be specifically looking at delta hedging. I'll show you how to monitor the delta, what to watch for, and then how to make the adjustment. So let's get started. Just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not consider your personal circumstances. So firstly, let's talk about why delta hedging is important. Iron condors are built around the idea of staying neutral and picking up time decay. But markets move, and when they do, your position picks up positive or negative delta. So that means you're no longer delta neutral, and you've got some directional exposure that you may not want. So let's go and look at a couple of examples. I'll show you what for and how to delta hedge them. So the first example we've got here is an iron condor on NVDA, and the stock's rallied and we've got a little bit of a skew happening. So typically with a condor, we want to be in the middle here of the structure. And I like to use an analogy. We look at this T+0 line, the purple line. That just stands for trade date plus 0 days, or basically how does the trade look as of today? And for a neutral trade like an iron condor, we want to stay here on top of the hill. We imagine this T+0 line is a hill, and we want to stay more or less on the top. So if you think about the price of the underlying, we can think about that being a ball, and we want the ball sitting on top of the hill. We don't want it to start to roll down the hill too quickly. Now in this sort of zone around here between about 158 and 164, the hill's still pretty flat. Our ball's not rolling too fast. Once we start to get past this point here, the ball starts to roll a bit quicker, the hill gets a bit steeper, and our losses start to pick up steam pretty quickly. So we always want to adjust before we get all the way to the short strike. We don't want to let the stock get down to or up to here at 175 and then try to adjust here. We want to do some delta hedging here at this point. So we've got 10 contracts here. We can see the short call delta is 23, the short put delta is 7.5. Overall, we've got a position delta of negative 86. If we times that 86 by the stock price, that gives us a delta dollars of 14,400 on the negative side. Now that's a lot larger than our capital at risk. So that's one of the things we want to monitor. We also want to monitor this T+0 hill and think of our analogy of that ball not rolling too far down the hill. So we can see here, this is a good time to perhaps delta hedge. If we wanted to do a full delta hedge, we would come in here and we would buy 86 shares of the stock, and that's going to completely neutralize the delta of the condor. So once we hit enter, you can see it significantly changes the structure of the graph. We've now got quite a lot of risk on the downside, obviously below a price of 145. We've added risk to the trade, but we've really flattened that T+0 line. We've flattened our hill. We're back on top of the hill, and it's not a very steep hill at all now. And we haven't sacrificed any theta. We're still picking up our $83 a day in theta from the underlying condor, but we've neutralized our delta risk. Now, I don't normally recommend doing a full delta hedge because that's a little bit extreme. What I usually do in the first case is about a 50% delta hedge. So rather than 86 shares, maybe we buy 43 shares. We've still got a little bit of negative delta here, but you can see our T+0 line's still a lot flatter. We've still got $1,000 in profit potential from this point onwards. And our risk of a further rally, we're not going to lose as much money. That ball's going to roll a little bit slower on that hill. So you can come up with your own rules around that, whether you want to fully delta hedge, 50%, 25%, 75% delta hedge, whatever you think works for you and whatever the scenario justifies, depending on how quickly the stock is rallying and how much you want to reduce your exposure. Now, the one downside of delta hedging is it's quite capital intensive. If we're going to buy 43 shares of NVIDIA at around 167.66, that's about 7,200 of capital that we're having to put into the trade to buy those shares. So that's the main downside. You do need quite a bit of capital to do this. If we're going to do the full delta hedge, that's going to be about $14,500 that we're going to have to put in to buy those shares. So that is the one downside. Let's look at another example. In this case, we're going to look at a stock that has dropped and we're getting under pressure on the downside. Again, we're starting to roll down that hill. We're getting a bit too close to the short strike, and our delta dollars is a lot larger than our capital at risk. In this case, the stock's dropped, so we've actually got positive delta dollars, positive delta, basically because we want the stock to go back up. Now, delta hedging on the downside is a little bit trickier because we have to actually short sell the stock. And some stocks may be restricted from short selling, and some investors may not have the ability to do that in their brokerage account. But if you do have the ability, again, if we wanted to do a full delta hedge, we would short sell 32 shares, fixes our T+0 line. Just zoom in a little bit. flattens our T plus zero line, reduces our risk of further losses on the downside, and we haven't sacrificed any theta. Now, 32 shares, a stock price of 708, we're going to receive about $22,500 in cash for selling those shares, but we've got to keep that cash in case we've got to buy the shares back. And if the stock has a big rally and it rallies back up, we're going to have to potentially buy those shares back for more than what we received when we short sold them. So again, that's the risk. You've got to have a fair bit of capital to do this type of delta hedging. Now, one little rule I have when I delta hedge in terms of removing the hedge when we no longer need it is I'll say if the stock gets back towards the middle of the condor, I'll take off the hedge and I'll just continue to manage that underlying condor position. So I like to set a price alert, say in this case, 720. If the stock gets back up to 720, I remove the delta hedge and I just continue managing the condor. Let's say it did get up to 720. We'd have to buy back 32 shares at 720. And that's going to be about 23,000. We're going to lose about $350, $400 on our delta hedge, but hopefully we can manage the condor and achieve somewhere near a full profit on the condor. And we've just lost a little bit of our delta hedge. It's allowed us to stay in the trade a little bit longer and maximize that theta. So this is a really good adjustment or strategy to use when we're getting close to expiration. Maybe you can't roll for a credit or it's difficult to roll the position, but we don't want to sacrifice any theta. So that's the main time that I'll use this strategy. If we go back to our NVIDIA example, I'd probably set a price alert about here, about 162. If it did drop back down to 162, I remove the delta hedge and I continue to just manage the underlying condor position. So as I touched on, you should consider delta hedging when delta dollars exceeds 2 times the max loss. Now, delta dollars is only available in interactive brokers, but it's very easy to calculate that number if you've got a different broker. I kind of touched on how to do that. I'll show you how to do it again. Delta dollars is simply a function of our position delta times the stock price. So if we say our delta of -86, that's our position delta times the stock price. That's our rough delta dollars number, which kind of agrees to what we're seeing here. If we do the same for ASML, we've got 32 delta, position delta. The stock price in this case is 707.38. Rough delta dollars, 22,636, very close to what interactive brokers are showing. So if you are using a different broker, you don't have this delta dollars figure available, really, really quick calculation to do in Excel. Another time you might consider delta hedging is when you're close to expiration so that you don't sacrifice any theta, and when rolling is too expensive or not easy to do and obtain a credit. Generally, that's going to happen when you're close to expiration as well. Iron condors are great. They're absolutely one of my favorite strategies, but only if you manage them really well. Delta hedging gives you that control when the market moves, so your trade doesn't get smashed. It's a really quick circuit breaker. If the market's making a big move, you just quickly buy some shares if it's moving up, or you sell short some shares if the stock's going down, obviously if you are able to do that. And don't forget, you can actually use options to delta hedge as well. You don't necessarily have to short sell the stock. If you've got, say, a negative 86 delta on NVIDIA, you could buy an 86 delta call, and that would also neutralize your delta. It's actually worth having a look at because it's actually a lot cheaper than buying or short selling the stock. And we've got an 86 delta. Here's an 82 delta, is pretty close. If we buy that call option, we've also hedged delta. We've neutralized our delta. We've flattened our T plus zero line, and we don't have that excess risk that we had on the downside. So that's perhaps a more preferential option, pardon the pun, or idea for certain traders. Now, you don't have to buy the 82 delta. You could buy 2 of the 40 deltas, which is going to give you a similar delta of about 80. That's also a really nice way to delta hedge. So a few quick tips for you. Monitor delta every day. Keep an eye on that T plus zero line. Keep an eye on your delta dollars. Try and keep the trade in the neutral zone. Always keep in mind that analogy of the ball sitting on top of the hill, and we don't want to let the ball roll too far down the hill. So thanks for watching. Let me know in the comments if you use delta hedging. And if you like the video, please remember to like, comment, and subscribe. And thanks for watching, and have a great day.